Happy to be with you, and always appreciate your insights on market commentary. So, kind of kicking everything off, I wanted to talk about, August was a pretty historic month in terms of volatility, downside, and then almost an immediate buying. There's, we basically went, 2 weeks down, 2 weeks back up, and almost went nowhere for the month. Just I want to get your thoughts on that, what caused that, and what that ultimately means.
Yeah, sure. So coming into August, we saw some economic data in late July, that I think gave investors some pause as to, all right, maybe we're seeing a real economic slowdown, and maybe the Fed is going to need to cut rates in order to counteract that slowdown, as opposed to just engineer this soft landing. Employment came back soft. Some of the ISM numbers kind of, after ticking back up, went back down. And then you got to August 5th, which is the day of the big sell-off and the spike in the volatility index, the VIX, which was actually a higher reading at one point in the day than we saw all the way going back to COVID. So all through 2022, when markets were off, didn't see a spike like this in volatility. And when we kind of replay that event, what happened was, people have kind of been talking about the unwinding of the Japanese yen carry trade, which people say that as if everyone knows exactly what that is. It's a pretty nuanced thing when you get into it, and the complications of it could get pretty deep. But all to say, you could really distill it down to what I would kind of call one-sided positioning. So a lot of people sort of set up on a trade to go one way, and when you involve leverage with something like that and the dynamics of it change to where people need to get out, when you have positioning that's one-sided, you start to get things going the other way. And when you have correlations and contagions across not only a single trade, but then a global interconnected financial system, it can kind of create some panic that's more or less engineered out of a trade, as opposed to fundamental conditions. So a lot of people blame that day on, well, we had that weak payroll report going back, looking at July. This was kind of an exacerbation of that. And the follow through that we saw in August kind of worked against that narrative, kind of said, as the data came in, the economy still is quite strong. The revised GDP numbers came back good for the second quarter. Kind of the look ahead for the third quarter is looking strong there. Some of the anecdotal weekly jobless claims reports have started to trend lower again. We got a payroll report coming up on this coming Friday. Today is September 3rd. That'll be for August. That'll be very telling. But all to say, the fundamental picture still looks pretty strong. And I think what we learned, and really not a surprise, is that when a lot of people get on one side of the trade, and forces work in order to have people selling the side of that trade that they're on, then you can get some kind of dislocations in the market that show themselves, and that can present itself in a temporary type of sell-off. But as you said, Eric, that's been all but completely clawed back at this point. We're at the first day of September, and markets are selling off, seeing a little pressure this morning, but pretty much kind of all back to all is good, all is calm as we go into the fall here.
Yeah, and so thinking back to that, as at least just from a price action standpoint, and as the data came in, it was more so structural positioning rather than fundamental issues. Now that to your point, there are some economic indicators that are starting to tick a little bit lower, but from a sell-off standpoint, it was mostly structural, right? It was more so positioning and rather than truly fundamentals.
Yeah, what kind of pushed it over the edge was the central bank of Japan sort of surprised markets by increasing interest rates. And when you do that, when you increase your interest rates of your local currency, you're going to serve to appreciate or strengthen that currency, the yen. So a lot of market participants were borrowing in yen and investing in other markets, whether it be U.S. Treasuries, whether it be something riskier like kind of Magnificent Seven, U.S. stocks. But essentially, the funding cost of that trade increased in short order whenever the central bank kind of surprised the market by doing that. So in a carry trade, what's fundamental is that whatever you're borrowing in has some sense of stability. So you can kind of
Mm,
count on X in order to invest in something else. Well, when you can't count on X any longer, then you get kind of some questions as to how sustainable is both legs of this trade. And as people with leverage had to unwind that, that's what kind of led to this move. So yeah, to your point, as it proved out, it probably wasn't something more fundamental. It was more particular to those particular market dynamics. And
yeah.
if there would have been something more concerning, I think we would have seen more follow through, and we didn't. So
Yeah. So in the context of central banks, looking at, it's hard to talk about markets today without talking about central banks. And I know that, the Fed has been under pressure for a while now to start easing, start cutting rates, kind of tailing back as inflation started to come down. And then looking back at the end of July, we started to have a little bit of weakness with manufacturing and jobs, those types of things. Um, you know, we're about 2 weeks away from the next Fed meeting. They're expected to cut interest rates at least 25 at this point. But I guess just give me a sense of how you're looking at navigating this with a expected cut. Because from my standpoint, it seems like, if they're cutting, depends on what context they're cutting in. If they're cutting into, a slowing economy, stocks, risk assets are gonna suffer most likely in that environment. And then, if they're cutting into a slowing, but look, you have some stability, controlled slowing a little bit. Stocks are going to look at that as positive. So like that's the way that I'm looking at that. I don't know if the rest of uh, other participants are looking at it like that, but I guess just love to hear your insights on that.
yeah, sure. So it's kind of this concept of soft first, hard landing. And when people say that, when you hear that on TV or whatever, landing means you're kind of coming down from heated fundamentals, heated kind of um, market outlook, pricing expectations. So if you think about coming down off of inflation, for example, in this wave that we've had since kind of the post-COVID regime, the landing is, okay, how do we get back to what's considered kind of normal? And do we do that in a fashion that is pretty smooth and growth slows, but never goes negative, never really causes concern, inflation gets back under control? That'd be a soft landing. Or is it a hard landing? Do we actually have a crash, some sort of recession, a big uptick in unemployment and people losing their jobs? Does it take that sort of movement in order to get inflation back in order to get kind of the economy back on trend, as you would say? So by all accounts, it looks like the Federal Reserve has been kind of given credit for engineering this soft landing, the ability to get inflation back in line, which by all accounts at this point, it has, at least on a year-over-year basis. Now you look back over kind of a 3-year period, and people are suffering from the fact that prices are generally up about 25% over the last 3 years, even though on a year-over-year basis, they look pretty good now.
Hmm.
But by all accounts, it appears that this is happening. You're not seeing unemployment getting out of control yet. You're seeing the economy continue to grow at a pretty favorable tick, but inflation's kind of come down. So the question becomes, all right, if things are more or less back in somewhat relative equilibrium, are interest rates being held too high by the Fed? And people are saying, yes, they are, and they need to cut. So we've seen this happen over the last 18 months about 7 or 8 times, where we've said the Fed's going to cut, the Fed's going to cut, and they end up keeping rates higher. There's been literally about 7 false starts over that time period. This one appears to be happening. I would say with 2 weeks left of the Fed meeting, it's more or less, for betting odds, 100% chance there's going to be some kind of cut. The question is, will it be 50 basis points or 25 basis points? Right now, there's about a 35-40% chance of there being a 50 basis point cut. So odds on it's 25 at this point. But the market's also pricing in 4 rate cuts. So 4 25 basis point cuts, or a full percentage point by the end of the year. And there's only 3 meetings left. So that means one of those is implied to have two rate cuts, and you also have a election thrown in there, which is a little bit of a kink, because Fed typically likes to appear neutral in those cases
Hmm.
and doesn't want to, be seen as cutting rates in order to influence the election or anything like that. So there's kind of some muddy waters here on what's going to happen. I would say the employment report for this Friday that's coming out for August is probably going to almost certainly dictate either way whether we go 25 or 50, especially given what last month looked like. If it's weak again, I think 50 becomes odds on. If it's more stabilized, like we've seen some of the data over the last 3 weeks since the last payroll report, I would say it leans toward 25.
Hmm.
So we'll see on that, but this does appear finally to be the time where we are going to get a rate cut here in 2 weeks.
Yeah, and so kind of to what I was talking about is more so the context that 50 basis point cut seems like the market would look at that as generally negative. So like, I think that like we look at, higher interest rates equals bad for stocks, but that's not always the case. Especially when you have a growing economy and lower interest rates don't always mean, good for stocks. So we're in a bit of a nuanced period, more than
Yeah.
usual, I think, with this cutting cycle.
Yeah,
So
you're right. If you look at historical rate cycles, it typically takes stairs up and then elevators down when the economy's kind of falling out and the Fed needs to try to come in and do whatever they can. So to your point, if they cut 50 basis points, it may be more influential in terms of the non-vocal message it's sending as opposed to just loosening financial conditions by 50 basis points. It may be more telling that hey, there's maybe more concern to be concerned about here than the market's seeing, and I'm not sure if the Fed wants to send that message. So, like you said, it's they have to evaluate not only the impact it's going to have quantitatively, but also qualitatively.
yeah, and so to your then you were saying that the biggest number that we're looking at is that this employment number for August as that comes out this Friday. A derivative of that is the consumer, right? So, we need the consumer needs to stay employed. But I guess just have like what is your sense for where the consumer currently sits today? And because that's going to be a longer term indicator of economic conditions and how we kind of weather this cutting cycle.
Yeah, sure. So I think over the last, again, go back 18 months, a lot of the financial media news is talk about savings and the state of the consumer and excess savings, what they have to spend. Coming out of COVID, the government just gave everyone money. And moreover, you had financial assets inflate as there was more money going through the systems. If you own stocks, your net worth's much higher than it was. You own a house, your net worth's much higher than it was. So there was a lot of net worth effect, both directly through stimulus and then indirectly through the inflating of financial assets. So there was kind of this thought that the consumer is flush and they're working down this excess savings or this kind of
Mhm.
excess liquidity. And hey, whenever that goes negative or whenever that reverts kind of below the mean of what we've seen long term in terms of savings, then you're no longer going to have a consumer that's supporting the economy anymore. And by a lot of accounts, we've reached that point. And yet, if you look anecdotally at some of the more qualitative type of commentary directly from consumer-facing companies, they're still saying, for the most part, hey, things are pretty good. We're holding up well. There has been some trade down, and there has been, I would say, more than anything else, some bifurcation between lower end and higher end consumers. And it kind of makes sense because if you're a middle to a kind of upper wealth cohort, you probably have a lot of your net worth tied up in financial assets, which have big time benefited over the last couple of years. The stock market's gone up, this housing has gone up. So you have kind of excess savings tied up in the fact that you've seen your portfolios increase. If you're on the
Mhm.
lower end of that, you may rent. You may not have a 401k or a stock portfolio that's stands to benefit as much. You're kind of reliant entirely on your wage in terms of supporting your spending decisions. And as that's been more or less in parity or almost actually at a slight under tracking where inflation's been, you kind of find yourself in a little bit tighter situation there. So I think consumer spending on the lower end has been difficult. I mean, look at if you look at kind of just the price action in Dollar General, over the last
Hmm.
12 months or so, it'd be kind of a good narrative of that. But overall, and if you look at kind of the blended economy, it's held in pretty well. One thing that's kind of interesting, sort of looking at the flip side of that, is that if you look at the 11 stock sectors that there are in the S&P 500, two of them are explicitly consumer facing. There's consumer discretionary and staples. So
Hmm.
discretionary, think Tesla, think Home Depot, think Amazon. For staples, think Costco, think Procter and Gamble, think Walmart. So the combination of those two sectors make up the lowest percentage of the S&P 500 that they have, going all the way back to the tech bubble of 1999. So it's kind of interesting that even though consumer continues to do pretty well, that those sectors have, on a relative basis, underperformed. And you could say, well, there's some, Apple, for example, is a tech company. Yet, a lot of people spend money on their new iPhone or their new
Hmm.
iPad. You think about Netflix is in the communications sector, whereas most of us have a Netflix account. We're paying that. We think of that as kind of discretionary type income. So there's some purchases in there that maybe don't fall exactly in line. Point being that there's a lot of different things we're looking at. You can't follow any one necessarily indicator and say this is exactly what's going on at any given time. But it's interesting how this is all playing out. And I would say on net, the consumer, the kind of the death of the consumer is just it's not really happened.
Hmm. Yeah. But the employment, especially on the low end, is a very, very vital um, sign to where the health of the consumer is. Because even if financial assets stay in this range or take a little bit lower, most, middle to upper class citizens, they still have that wealth effect, right? Whereas if you don't have that salary, your hourly wage coming in, that spending really, really drops off. And so that's something, to your point of why this employment number and why employment is starting to become more and more highlighted over inflation. It's seemingly inflation's like in the rear view mirror, and now we're just looking and hoping that employment stays relatively stable at this point. That's kind of seemingly the new narrative going forward.
Yeah, exactly. So the Federal Reserve has a dual mandate, so they say. So it's in price stability, so inflation, and then it's employment, unemployment, employment. So those two work in concert with one another. They are correlated. And as we've seen inflation go down, you'd expect to see unemployment to some degree go up. If the kind of historical relationship holds, those are correlated in that fashion. So you're right. As inflation has gone down, the baton's kind of been passed to unemployment. We're having a hard time, I think, getting good statistics on how the employment picture looks. For one, the response rates from the Bureau's surveys have been historically quite low since COVID. And then secondarily, the immigration picture has served to kind of skew employment statistics as well. So you see an employment rate rising pretty substantially over the last 6 or 12 months. But whereas historically we'd be quite concerned about that because that means people are losing jobs, a large component of this rise in unemployment has been from a supply standpoint. So you can get a rising unemployment rate by increasing the denominator, so more people losing their jobs, or you can get it by increasing the denominator, which is be more people in the job force. And that's what we've
Mm.
seen with both documented and undocumented people coming to the country at a pretty large rate over the last couple of years. And that served to increase the supply of labor, which has kind of directly served to increase the unemployment picture as well. So I think we have a hard time understanding exactly why things are being driven in that regard, but you're exactly right. The Fed, the markets, everything is much more fixated now on, are people keeping their jobs or losing the jobs versus inflation, which is, for at least for the time being, taking a backseat to employment for sure.
Yeah. Yeah. All right. Well, I want to kind of round out the session here with talking about seasonality, where seasonality's a little bit of a funny thing, but sometimes it works, sometimes it doesn't. But as we look back in July, seemingly, the first 2 weeks of July are some of the strongest seasonal trends that start to happen. And we saw that, we hit all-time highs in July, and then August, September are, seasonally weak periods. People are taking vacations. People are not, digesting economic news. There's a whole host of reasons why there's a lot of people, why August and September are weaker months. One question I do have is, since they're typically, when you get into these weaker periods, there's a lot of hedging that takes place. A lot of people start to protect on the downside. And we almost got that drawdown that we typically get in August and September, almost pulled forward right at the end of July. And so, I don't know if you have any thoughts around that. And then we're also coming into an election cycle, which, typically right before in October, we get another pullback. And so, I don't know how you guys are thinking about positioning and overall seasonality, but love to get your perspective there.
Yes, seasonality is curious because on one hand, it's kind of undeniable. I mean, if you look back over the last 42 years, go back to 1982, September is historically a negative month. It's the only month in that period that, it's the only month on the calendar during that 42-year period that has averaged a negative return over that time period. So on one hand, that's just fact. That's what's happened. It's kind of undeniable. On the other hand, if it were as easy as investing as just when that happens, then everyone would do it and it wouldn't happen, right? Or, if everyone is doing the same thing, it negates the very thing that's being done. So we certainly don't invest in terms of, hey, this has happened in the past, therefore it's going to happen again. That would be kind of overly simplistic, and again, it would end up negating itself by nature if everyone did that. With that said, like you said, I think people come off the summer, now they're back, potentially they're putting hedges on. Election year is different. This one was peculiar in the sense that the initial debate between Trump and Biden was the earliest presidential debate we've ever seen, going back since that they began televising those events. It kind of pulled forward a lot of that price action that maybe you see. But with Biden dropping out of the race, you've restarted it in one sense again, and now we have the first debate between the new participants here in the it's sometime in September. I think it's next week, perhaps. But you're going to start to see some kind of market reaction to what happens in these events as the odds between the candidates change, and how it looks like for Congress, and of course policy, and how that plays out. So you would expect to see more volatility in election year, certainly because of that dynamic happening. But I think as a money manager ourselves, we aren't making any sort of long-term decisions, honestly, based on seasonality or really election outcomes in general. I think we believe with the absence of kind of some sector-oriented type of trades that can happen based on policy, that markets largely, for the most part, over the long run, ignore election outcomes. I think more than anything, what we're able to do in a month like September that maybe is historically down is within some of the hedging strategies that we manage, both on the long vol, so buying protection, and on the short vol on selling upside to generate income. It presents unique opportunities in order to, I think, if you're a good manager, maximize both your positioning from a protection standpoint and generating income there. So I think we're doing some active things in the fund to take advantage of that, but definitely not saying, hey, get out in September, let's buy back in October. If they were that easy, we'd all do it. So
right. Well, Joseph, thank you again for joining us today to talk about August, and then kind of what we're looking out ahead of the election as well. So really appreciate your time and expertise, and look forward to the next one.
Yeah, my pleasure. Thanks, Eric.
Thanks.